Good afternoon. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, June 5th. As always, we like to talk about how historically challenging these times have been, and they can be hard ones for investors to navigate on their own, so we're here to help. We have over 1,400 clients who we truly care for, and it's our pleasure to help with all aspects of their financial planning. How you plan, invest, protect, and give, especially in uncertain times like these. We welcome a conversation with anyone who's interested in having one of those. You can see the title of today's presentation is We Are in This Together, and I chose this title because whether we like it or not, as Americans, we are in this together. Who would have guessed at the end of 2019 that we'd be trying to solve the health crisis of a pandemic unlike anything in 100 years, shutting down and then restarting the most productive free economy in the world, and then addressing the simmering issue of racial inequality all in the first 6 months of 2020. In each case, there seems to be national, even global issues, and the way forward seems to be to realize that we are in this together and that working together, whether on issues of public health, economic activity, or to deliver on the promise of justice for all, we can create the future we all hope for when we work together. I came across this quote from Martin Luther King that I think relates not only to the issues of race, but as we've seen this year also to public health and economic activity. He wrote, "Whatever affects one directly affects all indirectly." And we'll see that quote again at the end of our time together. But now let's look at the news of the last week. From May 30th to June 7th, local businesses continued to reopen, but they're having to navigate a combination of social distancing guidelines and widespread protests in certain cities sparked by the killing of George Floyd in Minneapolis. Coronavirus positive cases, seems like coronavirus took second place here in the news for the first time in a long time, but cases and testing are both growing faster than ever globally, with Latin America and Africa seeing new hotspots emerge. The United States has seen things get better, with New York actually opening today. Initial unemployment claims fell for the 9th consecutive week to 1.9 million. Continuing claims edged a little bit higher from 20.8 million to 21.5, but they are down considering that over 40.8 million claims have been filed in the last 10 weeks. You can see here those unemployment numbers graphically. You can see the spike in claims, and then those claims, the number of new claims going down dramatically. That's the top chart. But you can see those continuing claims continuing to stay relatively high. The big news last week was on Friday, the Friday May jobs report, which really surprised to the upside with 2.5 million new jobs in the month. And the reported unemployment rate actually fell to 13.3%. This was a big surprise to economists and the market alike, and the market responded extremely favorably on Friday, as it had most of the week, but Friday was a particularly good day. The NASDAQ index surpassed its pre-COVID market high during intraday trading on June 3rd and finished the week higher than it had been before the crisis. The tech index is the only major U.S. equity index in positive territory for 2020, but other indexes are catching up. The broader S&P 500 index approached break even for 2020 by a week's end, off its low of down 31.3%. MSCI All Country World ex-US, so these are stocks outside the United States, is down now just over 8% for 2020. And the aggregate bond index year to date has a return of over 5% for the first 5 months of 2020. You can see those returns for the week here. A couple things to note: some of the out of favor parts of the market really made up lost ground last week as well. Small cap value stocks ended the week up over 11%. That was just for the week. And real estate investment trusts ended the week up over 9%. A good week all in all in the market. Here's that picture of 2020 so far. You can see the CCMP, which is the NASDAQ composite, up 9%, a little bit more than 9% for the year. Bonds also performing positively for year to date. And you can see the S&P there, SPX, closing in on break even at the end of last week. And also those international stocks making up some good ground and coming back towards zero as well. All in all, it's been quite a quick recovery from the bottom in March. So the question is, one of the questions that's come up as we've talked with different clients and other folks is, how's the U.S. going to pay for all this new debt spending? As a result of the crisis that we've been in, obviously the government introduced lots of stimulus programs and lots of spending that's going to be funded by new debt that the United States is issuing. Here's just some numbers that kind of outline the amount of that debt. $2+ trillion in U.S. government stimulus aid through the CARES Act and Supplemental Paycheck Protection Program for small business. There's an estimate of $4.5 trillion of U.S. Treasury debt issuance by the end of September this year. That compares with $1.28 trillion in 2019. So you can see the additional issuance of debt in 2020. That some people have been comparing that debt issuance to our GDP. You can see that if we issue that much debt, we're talking about just in the CARES Act alone, that amounted to 10% of 2019's GDP. So one of the statistics you hear talked about is the debt to GDP ratio. And here you can see the picture of the US debt to GDP ratio going back to slightly before World War II. It peaked in World War II. You can see it up there around 120, 130% of GDP in the 1940s. And then it went way down, kind of bottoming out in the early 1980s. And it's been really rising kind of marginally since then. An author that I like to read, Morgan Housel, he wrote this. He says, as long as nominal GDP growth is higher than the annual budget deficit, debt to GDP goes down. And spending more than you take in leaves you actually with a lower debt burden. That's because your GDP is going up. So your debt to GDP ratio is actually going down, even though you might be taking on a little more debt. You can kind of see the US debt to GDP as it relates to other countries around the world. The blue arrow there is pointing at the United States. This is for the year ended 2018, which is the most recent year where we have good global data per country. You can see to the right of the United States, Italy has a higher debt to GDP burden, Greece, Japan, some of those high debt countries. The other thing you can notice here is having a lower debt to GDP number doesn't necessarily mean you have a healthy economy. If you look back, some countries with significantly lower debt to GDP numbers than the United States include Mexico, Colombia, Turkey, not places that you'd describe as necessarily overwhelmingly healthy or dynamic economies, but they do have lower debt to GDP ratios. How has this changed through time? If we look forward, this is now looking at that same ratio, but as of the year 2000, you can see here similar ranking in terms of where different countries are, just lower numbers. Since the great financial crisis, the debt to GDP ratios of many countries have risen because of the stimulus first implemented during the great financial crisis, 2007 to 2009. And then we anticipate more of that happening here with the coronavirus crisis worldwide. So what are some things that we should be taking away when we think about, hey, how does this impact the economy and what does this mean for stock market investors or bond market investors in particular? Some key ideas to keep in mind when we think about national debt, US debt to GDP is one is that the government's not a household with a retirement date. In other words, the government does not have to come to a point where they pay off all their debt. The United States is an ongoing entity. It will probably always have some type of national debt. The last time the U.S. didn't have any debt was 1835. Unfortunately, that was immediately prior to one of the worst financial crises in American history. What are some ways that the U.S. government can address this kind of growing debt issue? Well, one of the ways we talked about earlier is you can grow the economy. If you grow GDP, you can make debt actually a smaller portion of the economy if you can grow the economy faster than your national debt. You can raise taxes. We could try to raise revenue to pay down some of the debt or to stay ahead of the cost of that debt. You can reduce spending, same type of thing, borrow less into the future. Another way sometimes that debt is thought maybe to go down is if we have inflation. That means that dollars today are worth less in the future, so it costs less in the future, relatively speaking, in terms of inflation-adjusted dollars to pay off the debt that we take out today. Not necessarily the way that most people think they want to do it, but it is a way that debt can actually become a lower burden in the future. Historically, the U.S. has really been able to grow itself fast enough to keep the national debt from becoming a significant drain on the economy. How far this can be stretched is kind of hard to say, but the idea that today's debt burden poses an imminent threat really overstates the problem. We have low interest rates, low inflation, relatively low tax rates today, and the strength of the dollar does give us some time and tools to get the economy growing, to maintain a manageable interest expense and raise revenues if needed. As a matter of fact, if you think about the stock market as a leading indicator, the stock market is looking ahead to 2021 saying, you can see those stock market prices going up. And what's happening is the stock market saying, we think the economy is going to recover. and that recovery is going to be good. And so GDP will begin to grow, and this debt problem won't be crippling or won't be the kind of thing that should slow us down. Now, that's the view of the stock market today. It can always change, but that's one of the things I think that's embedded in these stock market prices as they've risen so dramatically in the last few weeks. Another way to look at or think about our debt is the percentage of GDP that is taken in terms of tax receipts. So when you think about how many dollars United States citizens pay in taxes, what this does is this just says, well, what percent of GDP do we pay in taxes? And you can see here going back to World War II, that number has kind of centered around the mid-teens, though it's really been all over the map. Matter of fact, top marginal rates have varied greatly from 24% to 94% actually in 1945. We're currently at the lower end of where those rate tiers have been historically. The magic of a rate structure is you want a rate structure that funds the national priorities without slowing down or crippling the economy. Another measure of kind of health in terms of thinking about GDP and what it costs for us to have national debt is the cost of the interest expense associated with the debt. Again, Morgan Housel, a financial writer, he writes, what matters for countries isn't the amount of debt they hold, it's how burdensome that debt is to maintain over time. That makes sense if you just think about households. Some households, let's say you have a household making $100,000 and they have a $500 a month car payment versus a different household that maybe has $25,000 of annual income trying to make that same $500 payment. The payment for the $100,000 household, $500, is less of a burden than for the $25,000 household. It just makes sense. As we look at this, what we see here is the cost of carrying the debt. Again, going back to the 1940s, you can see that the cost of carrying the debt in the United States peaked in the 1980s, not because the debt was greater in dollar terms than it is now, but because interest costs were so much higher in that period in our history. Since that time, interest rates have declined considerably, making the cost of carrying the debt much lower than it was in the 1980s and early 1990s. Currently, for every $1 trillion we borrow at the prevailing 30-year Treasury rate, the interest expense is just about $11.7 billion a year. At 10-year yields, the annual interest expense is just $5.8 billion per $1 trillion. So when you think about those billions of dollars, while that's a lot of money in terms of interest expenses, when you have multi-trillion-dollar economy, a few more $1 billion in interest expense, while it's a lot of money, it's not that much relative to the size of the economy. You can see that in the chart as we look at it here. These next three charts, I've done something to impose or to superimpose the return of the U.S. stock market since the 1940s, looking at it against or charted in kind of comparison to those debt to GDP and interest rate costs. The reason I've done that is because a lot of people say, well, isn't this accumulation of debt or these additional costs, isn't that going to be bad for stock market returns in the future? Wouldn't, let's say, increased taxes be bad for stock market returns in the future? And really what we want to do is look at the past and say, well, what's happened to the stock market and stock market investors when we look at past periods in history? Here I've taken that same debt to GDP number that we started with. I put on the S&P 500 and I've made it into a log scale for comparison purposes. But what you can see is the US stock market, represented by the blue line, has had a relatively steady increase, very strong increase over time. And it's done so with a debt to GDP ratio that doesn't resemble that stock market return shape at all. The stock market continued to do well all the way through these different kinds of debt to GDP ratio periods. Same thing is true when we look at tax receipts. Again, the tax receipts look a lot more uneven in terms of going up or down as a percentage of GDP. But what you look at is regardless of what the shape of that curve has been in terms of tax receipts to GDP as a percent, the stock market continued to do well through most all of those periods. Certainly there were periods when the stock market declined, but you would have a hard time linking that decline to tax rates, at least as a direct correlation. That's something we've talked about before, that the correlation between the stock market and the US economy is really, really hard to make. Most statisticians and economists would say they're not correlated, actually. The last chart, again, is the cost of carrying debt. So this is the interest cost as a percent of GDP. And again, same idea here. You look at it and you have to look pretty hard, but what you see is the stock market continuing to rise over long periods of time through all different kinds of tax to GDP ratios. I think the takeaway here is that the economy and the stock market are not necessarily directly correlated. Certainly, the health of the economy says a lot about what can be possible in the stock market and how companies are going to do. But also, company health has a lot to do with how GDP is doing. When we have healthy companies producing at a very high rate, being very successful, that's great for GDP because they're being productive, hiring people. They're actually adding to the size of the US economy, which means if we do have increased borrowing, that debt to GDP ratio would actually be going down because the economy would be expanding. I want to close again with a quote that I started with earlier, because I think this relates again to the things that we're experiencing right now with the protests that are happening in different cities, but also when we think about our experience with the coronavirus and the shutting down of the economy for that 2 or 3 months as we slowly come back to life here in the United States. It's this idea, and I think Martin Luther King said it so well, or wrote it so well here in his letter. He said, whatever affects one directly affects all indirectly. It's hard to say that we're not really all in this together. That's really true whether it's in issues of race and justice, but it's also true in issues of public health in time of pandemic or economic growth. We are all on it together. I know we all want to succeed. I think we can find ways to do it if we look at history we've done in the past. I expect that we'll do it again. Thank you for attending again this week. If you have any comments or questions for the team at Foster Group, here's ways that you can contact us. And also, if you're listening to this and you're not a client of Foster Group, but you'd like to get together with an advisor to talk about your situation, maybe have a second opinion on how you're investing or how you're doing your financial planning for the future, we have a team of advisors, very qualified. They'd love to have that conversation with you. If you know someone who you think we could help, we'd be glad to be introduced to them as well. So thanks again. We'll look forward to talking with you soon.